rents have finally caught up to make returns justifiable for the higher construction cost. One piece that still hasn't completely hit is the exit on those with the higher rents. So the per square foot exits are yet to be seen, as developers haven't really been building this product until call it now.
Mhm.
So effectively, we're kind of chasing that product because there's low vacancy, rents are higher, and so generally there's some rent growth as well implied there. And so when we're looking at deals today, we're looking at some sort of value add component or some development deals, not typically stabilized unless those stabilized deals have some substantial mark to market on the
Are
rent
you
side.
looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted
Hey
Patel.
everyone, this is your host Ted Patel, and welcome to this week's edition of the Decoding Cash Flow podcast. I'm here with Gregg Gruehl, who is a founder of GCMP, a firm focused on industrial real estate investment. Greg brings extensive experience in real estate acquisition, leasing, and asset management, and having held key roles at leading REITs and private equity firms. So, Greg, welcome to Decoding Cash Flow. I just gave a very succinct introduction. Maybe you can dive deep into your background as we go along. So, welcome, Greg.
Thank you for having me,
Yeah.
Ted. I appreciate the chance to be on the show and the chance to share my story with your listeners.
All right. Yeah, it's gonna be a great podcast, man. So, before we get started, right, or dived into the niche, if you can give our listeners a little bit background about yourself, how did you get started in real estate and what is your main focus as of now?
Yeah, so my family's been in real estate for generations. It all kind of started back actually with my great grandmother during World War II. When my great grandfather was fighting over in World War II and ultimately passed away, she got her real estate sales license in 1942. Um, and she was left with my 1 year old grandfather at the time. So she carried her license through to her passing, which kind of went on to my grandfather, who was on and off in the real estate game, but he was always a licensed salesperson in the state of Ohio, uh, really till he passed away as well. Um, Mainly, though, their business was focused on housing, which we didn't really follow in their footsteps there. So my dad, however, after he graduated college, went directly to commercial brokerage, focusing on retail properties. So you can kind of say that's where my brother and I kind of, took after the family business. When I was 18, my dad had us read Rich Dad Poor Dad, read the book, made me really have a drive to be an entrepreneur, but didn't really know how I was going to go about that. So went to school after a couple of years of playing hockey. Um, Came out of school, did not want to go into brokerage like my father. Saw the ups and downs, the ebbs and flows of his cash flow, and said, you know what? Let me get a well-rounded education on the principal side. So after college, I took a job as a management trainee for a large shopping center REIT. So basically, I rotated through different departments, mainly in property management. After that, moved on to multifamily, where I was an asset manager. That firm is now a $7 billion firm looking to go convert to a REIT from a private equity shop.
Mhm.
From there, my wife and I moved out to California. Took a big risk, joined up with a firm that ended up being one of the most well-founded startups and in the industrial space. This was founded by Blackstone after they had exited industrial. The firm at the time was called Gateway Industrial. Today it's Link Logistics, which is the second largest owner of industrial in the US behind Prologis. There, I
Mhm.
was an asset manager as well as, and then kind of converted focus on the leasing side. Um, COVID hit, wanted to move back to Ohio, joined up, wanted to round out my background. So took an acquisitions role back here in Columbus for Stag Industrial, one of the largest public REITs on the industrial side, doing acquisitions throughout the Midwest and part of the Mid Atlantic. So kind of rounded out like operations, leasing, and then acquisitions. So saw all kinds of deals, and that's where I finally, felt that my education had reached its point, when I left Stag ultimately to join up with my brother to start GCMP. Um, we're focused on kind of setting up private equity deals and transactions on the industrial side, kind of focusing, call it, somewhat institutional, but call it the smaller size institutional deals, more sub-institutional Class B type assets where the big institutions, my old firms, aren't getting down to that acquisition size, call it sub $15 million typically. So that's kind of the background of and the genesis of my personal background. We I've been in real estate my whole career. That's my focus, and I've had quite the journeys along the way.
All right. So you have been at the Link Logistic as well as Stag, right? What sparked your interest in leaving the job and starting your own firm? Like, was there any pivotal moment, or were you always from the beginning you wanted to do your own business?
So a couple things. So I would say the goal always since the time I was 18 was to always work towards that. I would have
Okay.
said I would have stayed in the acquisitions role at Stag for several more years. I was laid off due to downsizing. But by that next Monday, being laid off on Friday, my brother and I were already working together in the office that he had. So because I viewed that as this is finally it. Like I don't need to do any more to really push me out of the nest, if you will, of comfort. I was able to have some very large roles and well-paying jobs for where we live, but I didn't feel like I needed to continue that path to really grow my career. I thought the next kind of step in the genesis was to finally take that leap that I was going to take inevitably anyways,
Hmm.
just probably 5 years ahead of where I would have, like, if I could plan my life, would have done, right?
Hmm.
But I think ultimately it's forcing me to grow at a much quicker clip, and putting me into situations where I'm learning very rapidly, which I find very exciting. Albeit we're bootstrapping, so it's also nerve-wracking, but it's also, very exciting for sure.
And as you mentioned earlier, right? Um, in GCMP, not only you focus on the industrial property, but there are other avenues also you focus on. Uh, if you can give us a little bit background on what are the first, yeah, give us a background on the other things, and then we'll dive deep into the industrial things.
Yeah.
Yeah.
So we're doing a couple things. So my main day-to-day focus is industrial real estate, private equity style deals, raising capital, about underwriting deals, raising capital, forming some sort of GP LP relationship. My brother, however, brings an extensive background in housing, and he knows some of the substantial residential wholesalers. So in our world, in the industrial world, your deals take a long time to cycle. So
Yeah.
from underwriting a deal, which we've underwritten hundreds in the 6 months we've been here. So deal flow is not an issue. It's just about finding the right deals, and hitting the right prices for the sellers, right?
Hmm.
And that with returns that work for us. So we want to have our first acquisition be the right one. Honestly, that's the most feedback that I've gotten from almost anyone that has started in this business is make sure your first acquisition is one that works.
Yeah, that's
So
true.
we're being careful,
Hmm.
and we're taking our time. So that said, we're 6 months in, and in that business, you make money by doing acquisitions and getting equity stakes, asset management fees, and the like. Well, we're 6 months in, so that means there's no revenue on that side. So we decided to put a little money towards generating leads for residential wholesaling to make cash flow. So my brother,
Hmm.
as well as a commission sales employee, are generating revenues for our business, to fill the intermittent time. For example, we're underwriting a deal today, that we're in the middle of bidding on the industrial side. Well, we won't even make any revenue on that, call it, for 3 months.
Yeah.
So that said, in the housing cycle, we can make revenue 7 days from the time we talk to a seller. So the idea is to funnel cash flows to, call it cover the overhead and the marketing
Mhm.
expenses
Yeah,
for my side of the business.
understood. And in the industrial space, there are many different asset classes, storage or, multi-tenant, industrial, single tenants. What exactly within the industrial space you go after? Like, what
Yeah,
is your
so
thing? Yeah.
so our niche in the industrial space is called shallow bay or flex. We're really trying to stay
Okay.
away from bulk industrial, which was call it overbuilt during the COVID period, which is where you're seeing a lot of the vacancy in industrial spaces, Class
Hmm.
A bulk. So call that 300,000 square foot
Hmm.
buildings. Our focus is an area where very few developers have developed due to high development costs and not high enough rents historically, which is called shallow bay flex. We're kind of staying under 100,000 square feet. We want to be multi-tenanted, so we're not designing buildings for 100,000 square foot users. We're kind of want to look at like 4 users on the 100,000 square feet. But our bread and butter is
Hmm.
probably 60 to 80,000 square feet with call it 15 to 20,000 square foot suites. Um,
Hmm.
Rents have finally caught up to make returns justifiable for the higher construction cost. One piece that still hasn't completely hit is the exit on those with the higher rents. So the per square foot exits are yet to be seen, as developers haven't really been building this product until call it now. So
Hmm.
effectively, we're kind of chasing that product because there's low vacancy, rents are higher. And so generally there's some rent growth as well implied there. And so when we're looking at deals today, we're looking at some sort of value add component or some development deals, not typically stabilized unless those stabilized deals have some substantial mark to market on the rents side of things. So
Hmm.
today, we're looking at a building expansion in Virginia, um, where there's an existing building, 60,000 square feet. It's fully leased. The rents are call it 20% below market when they come up to renewal.
Hmm.
So there's some value there, but where the main value is that you can expand the building by 45,000 square feet.
Okay.
So it's kind of like you have a stabilized deal and a development deal in one, which you can share the costs of the land and other DD expenses across the two kind of call it deals. You can separate them, but they're really, one deal. So that generates kind of outsized returns as opposed to just the stable building. The stable building's typical low IRRs, 12 to 14%, but with the development component, you can get into the high teens, even low 20s, depending on how bullish your underwriting is. So
Hmm.
we're looking at that as well as a couple of ground up sites that we're trading LOIs on that property, as well as a couple of different land sites right now, where your project level IRRs are in the low 20s. So that's kind of where we're focused, and that's due to the low vacancy and the higher rents and the implied rent growth that you get when you have low vacancy.
Hmm. And what is the typical building cost per square foot in your industry? Like the where did you focusing?
So where I'm focusing to build today,
Hmm.
versus, I'm typically looking at construction costs in the 160s.
Okay.
Your exits are probably in the low 200s to two teens.
Hmm.
Um, and some even higher depending on how long the whole period is. And this is why I mentioned historically the exits aren't there. Like your highest trade, for example, in Columbus, on a per square foot basis for any industrial is about $145 a square foot. But that's also on rents substantially lower. That's on $7 to $8 rents. The rents
Hmm.
on these flex properties on Class A flex, Shallow Bay, and Columbus are almost $14, if not
Okay.
$14 on some of the newer stuff. So that puts those exits to be at around today's market cap, call it a 6 to 6.25. That puts those exit at about 215 bucks a square foot. So um, you're really solving to try and build somewhere around 160 a foot if you're building new development, and that's kind of where we're solving to roughly on the expansion as well.
Okay. And what are the main categories of tenant for your flex space?
Yeah, so flex spaces can kind of be all over the place. So
Yeah.
you typically think you can have local businesses, right? You can
Yeah.
have from your mom and pops. You can have general contractors. You have a lot of flooring, housing related
Yeah.
building products. Sometimes with more showrooms, so you do end up with some more office. Call it 5 to anywhere to sometimes you have 50% office, but on the newer product, we're trying to stay below 10% office. We're not really trying to be like full flex, more so
Hmm.
shallow bay. In the building we're looking at in Virginia right now, I mean, there's a coffin manufacturer that distributes out of the building. There's a moving company that has a customer that stores their items there that has high throughput, but it's only 12,000 square feet. And then there's a manufacturer of equipment that goes into um, wind farms. So you can kind of get the gambit of mom and pop, local retailers. You can get some small 3PLs, but you can also have light manufacturing as well. So it really kind of runs the gambit of what you'll see. But what I would say is like with industrial, and if people, listeners aren't too familiar with industrial, but industrial basically is where all of the US GDP flows through. So any business you can possibly think of, typically if they have a physical product, it will go through a warehouse. There's pretty much or a manufacturing facility
Yeah.
like that.
Yeah. They need to manufacture or store, and they need the space for that.
Correct. You can't just
Yeah.
do it out of your garage. It's not a software business. I mean, although you
Yeah.
will, there's potential that sometimes in warehouse, like you'll be utilizing the space for, some of the office needs for
Yeah.
engineers as well.
Yeah. All right. And as you mentioned, right, you you're still in the process of scaling your company, right? So what, how did you start the deal flow at the first place when you started GCMP? All right.
Yeah,
What was the
yeah.
first steps that you do so that deal flow starts and keep so that you can keep underwriting new deals?
So yeah, I would say that's where the nuance of industrial comes in, right? Because um, we started 6 months ago. If you did not work in industrial prior, it'd be very hard to start.
Hmm.
So I had deal flow the immediate second I left. I called
Okay.
brokers that I knew that had assets on the market. We started underwriting with market deals. My brother started hunting, deals and calling individual owners for potential sale leasebacks or sales of their buildings in general. So that's kind of how we started with deal flow,
Hmm.
um, where an individual who's starting with no background would struggle. And that's why I think a lot of people kind of stick to, they go from residential. A lot of investors in real estate start with residential. They start with single family. They get a couple duplexes. They go on to multifamily. It's kind of a genesis over a long time. They start seeing the smaller multifamily, and then maybe they grow into the bigger. We're coming from zero, but that not really because my background led to a lot of the relationships required
Hmm.
in all kinds of different markets. Yes, you can go on Crexy and look up industrial deals, but usually that's lower class for the most part. You're seeing C class to lower B class buildings for the most part, or overpriced listings on there.
Hmm.
And that's really not where we're hunting from. We're hunting from my personal relationships over my on the industrial side, my 8+ years in industrial. So those are relationships that have taken a long time to form. But I get to know about deals on and off market. I know the local developers in all the markets I've covered historically, as well as brokers. So, I constantly on the phone talking to them about new deal potentials. And now I would say we also source deals just by me continuously posting on social media and people that through LinkedIn, and people reach out to me saying, "Hey, here's a deal off market that you can look at." And so we're seeing a ton of that kind of deal flow because honestly, in the space of LinkedIn, most people are on the multifamily side, and I'm
Hmm.
one of the few people kind of posting that I want to bring industrial to a syndicated platform where most industrial deals. Probably because it's business to business as opposed to business to consumer, like multifamily or residential, is typically held by institutions, family offices, or ultra high net worths that are participating in funds. You don't typically find somebody syndicating $50,000 shares on the industrial side like you do in the multifamily space.
Hmm. So what are the tips? of finding a great off-market deals. Like if someone wants to get started, right? Of course, you mentioned Craigslist and everything, but those deals have passed through many eyes, and sometimes it's not even worth looking at it. So how do the new or the beginners start getting those off-market deals?
Yeah, so on the industrial side, I would say if you're trying to find off-market deals, I would get acclimated with industrial. So I would start, if I was starting from scratch completely, not knowing and saying, I want to be an industrial for whatever reason. First, I would get an education from a local broker,
Mhm.
regardless, so you can understand. And they may or may not take you seriously, so you got to hound them. Um, then second, once you have an understanding of the fundamentals of the industrial space and how it ultimately operates, I would say you probably you got to pull lists from somewhere or some data source like a Reonomy, or Crexy also does have off market research as well, where you can pull lists and find out who are owners of buildings. So if you're going to target off market deals completely, you're going to pull those lists of owners who either operate out of the building or only own, a couple of buildings. Probably you're not going to be calling your institutions because they won't typically sell them to you off
Yeah.
market unless they're smaller, or have a personal relationship already, because they have institutions care about surety of close and confidence in closing the deal.
Yeah.
So they're not going to typically take you too seriously if you have zero experience or track record. So that's where you would kind of start, and you would call those owners. If you understand the fundamentals, one of the big things that I would say is you have to understand the underwriting,
Mhm.
um, which would be hard to do. You don't find as much of like the Instagram course on industrial or the YouTube videos on how to underwrite industrial like you can if you YouTubed multifamily underwriting, right? Like you can kind of pick it up through YouTube University.
Yeah.
The industrial side really just doesn't have a ton of that, which I think is a nice niche for me to play in. Now, I will say I'm competing with bigger shops and family offices, so it is tough to gain surety of close, and I can kind of dive into like why we're structuring our certain deals. We have different structures, so to gain the confidence of a seller in the deal in Virginia, I've already lined up a joint venture partner who operates in a different asset class, but they want to utilize us as their industrial operator. So
Okay.
we're gonna joint venture that one, right? And we're not even gonna syndicate the equity like I'm marketing. Now, what that does is it gives people more confidence to then partner with us, or to be able to give individual investors the ability to see what we're doing, right, with a track record. So then the idea is, on the development deals, we have a couple of land developers that want to partner with us where we are going to syndicate that equity. So basically, in those cases, they're bringing the surety of close to the land sellers on the development,
Okay.
and the joint venture partner is bringing the surety of close to the institutional shop that we're trying to buy the Virginia deal from. So you got to kind of figure out surety of close and the ability to sign on debt, right? Because these are, um, call it $5 to $15 million deals. Most people starting private equity shops or real estate investment aren't liquid enough to sign on the notes themselves. So
Yeah.
that's another hindrance to this industrial game. So if you were just starting out from scratch, I would say you're probably going to stay sub $3 million. It provides a little bit of ease on some of these other things. You're going to typically only have mom and pop owners, and you can typically find one of your syndicated investors or a pool of them to sign on the note with you. So there's different strategies to go in. My background happens to be institutional and understanding family offices. So we're meeting with family offices, other operators in other spaces, and partnering with them just because due to my track record and background at the institutional
Mhm.
shops.
Yeah. So you're leveraging your knowledge, partnering with someone who is not in the industrial space and wants to get in the industrial space, and just getting, they have the capital, you have the knowledge, you can bring in the deals, just get together and close the deal.
Exactly. And I mean, I would tell you like that's not our overall ultimate goal, because that isn't the best economic situation for our firm in the long run, but it is our goal to get, call it deals 1 through 5 through the door so we can build that track record, build up the equity in the company. So that way we can sign on the notes deals 5 through infinity. Now we still probably will have partners because maybe the deal size will grow, right?
Yeah.
But we do want to save um, some of the equity for syndicating out to friends, family, as well as, your typical everyday accredited investor that invests like a $50,000 share. We really want to be that industrial provider for people.
Mm-hmm. All right. Now, jumping onto the underwriting, right? As you mentioned earlier, also the underwriting for industrial is quite different than the residential underwriting, right? So, what are the different aspects that you keep in mind while underwriting these properties? What are the numbers and things that you consider?
Yeah, so I mean, honestly, in a lot of ways, I would say it's simpler. So industrial is very simple in that it's four walls and a roof, and it's usually a rectangle, right?
Yeah.
So very simple in that aspect. You don't have hundreds of tenants like you do in multifamily. So let's use the example of we have four tenants. Let's say they're all the same size. So really, you're kind of focused on a few key metrics, which is your market rent. So whatever properties are leasing for today, of like kind and size and call it comparables,
Hmm.
um, not necessarily where the rents are in place for the tenant. So you want to understand that. You want to understand your market cap rates for that type of asset. So call it your sub 100,000 square feet for our shallow bay. That varies. In certain markets it could be a six cap, in certain markets it could be seven, right? So you want to understand that. You want to understand your quality as compared, whether it's kind of like the A property institutional quality, or if it's B and it's still institutional, or if it's B but it's not quite institutional for size purposes or location. You need to understand location heavily. Industrial location is key because
Yeah.
typically it has to do with transportation. So you want to be close to highway access. You potentially want to be close to a port, or a cargo airport as well.
Hmm.
So those are and when I say transportation highway access, some cities are actually better and markets are better than others. Um, for example, I sit here in Columbus. We're right on 70 and 71. So that is good highway access. 70, kind of goes all the way across the country. 71 goes all the way down to Florida from Cleveland. So you kind of have good kind of cross-sectional traffic patterns. So that's kind of what you want to be located somewhere near, and you don't have to be right on either of those, but ability to get to that quickly. So like if
Yeah.
you're somewhere in Columbus, if you can get to 71 or 70 quickly, and Columbus isn't that big, so as long as you can get to 70 more so than 71, you're in a good spot. The
Hmm.
properties that are farther from those kind of highway access points, typically lease for a little bit less. In other markets where, and a big thing to consider is your kind of your truck 2 day drive time, and 1 day drive time, because trucks can only drive for roughly 10 hours or so. So you
Yeah.
want to understand how far they can get from you. So a lot of times when you get a broker OM, they'll overlay how far the truck can go in 2 day, 1 day, 2 days, 3 days. Usually
Hmm.
3 days, you can cover almost the whole country depending on where you're at. But 2 days is kind of like, 1 day is like, all right, cool. Like you can cover 60 or 70% of the, and population is where this matters because you don't need to necessarily cover North Dakota, but population, like, so you'll see if you're on the East Coast, hey, we can hit the entire Eastern seaboard because we're in uh, Richmond, Virginia, or Norfolk, Virginia, where there's a port. Within 2 days, I can get all the way out to Chicago, and I can
Yeah.
hit the whole side of the country. So that's very important when you're underwriting industrial, is location. And in the shallow bay size, that might not be as important because you're not typically shipping far. Those are typically users that are servicing the local market. So you want to get highway access to get to the local market quickly.
Hmm.
Um, and so you really are looking at, call it the transportation, the basically, so location, building quality, and then you'll look at tenant credit that's in the building existing, as well as kind of leasing demand and vacancy rates for the market that you're looking at, as well as submarket, because sometimes with shallow bay, submarket's very important because you might be servicing only a subsector of the local market. And typically you'll see in the shallow bay side a business owner that actually travels into work. So usually that also has to do with proximity to rooftops,
Hmm.
and housing as well.
And these are all triple net lease that you look at, or there are some.
So
Yeah.
we are primarily, I would say, 98% of deals I've underwritten are triple net. You start getting into gross leases as well when you look at older properties or Class C properties, which we're
Hmm.
typically staying away from kind of both of those. Um, because it adds a certain complexity. There's some value that you can create by converting an asset to from gross to net,
Hmm.
for sure, and kind of enhancing the properties, right? But we're typically not doing those kinds of deals where we're just kind of industrial is tough to do the, hey, we're going to paint the building and redo the parking lot. And that adds a ton of value because you typically are budgeting for that in CapEx in general already. So it doesn't typically like massively improve rents. Now it improves curb appeal of the asset. So when a tenant is touring a vacancy, it does improve the curb appeal, but you're typically giving tenant improvements anyways to improve the space. So unless you're going to do things like raise the roof on a building to add clear height, which
Hmm.
isn't usually always economical, or expanding the building, which is where we're focused, you're not going to be able to like drive a ton of value. You might get you know, a few a few pennies to 50 cents on your rent, but nothing astronomical.
Yeah. Or maybe adding a bay area for the truck, right? 18 wheelers.
Yeah, so IOS, industrial outside storage, if you have the excess land. So that was one of the analysis pieces we did when we were looking at the deal in Virginia is do we add the building? Do we add 45,000 square feet to the building? Or do we add 2+ acres of industrial outside storage, which leased at a good rate? Ultimately, in our underwriting, we viewed the upside on the building more so, because it was more stable as well, once you leased up because iOS typically short-term leases, and then a little bit longer downtimes.
Hmm.
And then the buyers, when you sell the building, don't attribute the same value to the cash flows, as they would if there was a building with the same
Hmm.
cash flows.
So, of course, all the rents varies based on the location, right? Where it is located and the type of the building it is. But what is your typical rent and an average, uh, typical rent and typical cost per square feet?
Yeah, so if you're looking at um, the call it the shallow bay, call it 15,000 square foot to 20,000 square feet, you're going to see rents that are double digit pretty much across the board if you're class B and above. You might see some markets that are less than that. In the markets that we are operating in, we're seeing north of $12 on
Mhm.
your typical rents, for that kind of size space. It gets higher as you get smaller, and then we're as you pertains to cost, it depends on which way you go with what you're thinking of cost for us.
Uh, Acquisition cost per square feet.
Yeah, so acquisition costs, and I mean, on that size range, you could be in the mid 100s,
Okay.
give or take. It depends. It can be lower, but on the call it the B stuff, you're going to be in the mid 100s. Replacement cost is probably in the 160s to 170s. So development
Mhm.
cost is the same as replacement cost effectively.
Yeah. Okay. All right. And the next stage, right? You spoke about the underwriting also. Now, asset management aspect of these properties.
Mhm.
If you can give our listeners a little bit of what are the different things that you need to take care of while
Yeah.
you own the building.
Yeah. So these buildings aren't crazily management intensive. So
Yeah.
you'll have in-house property management or you'll third party property management. So the asset manager will oversee a property manager who will typically handle, because it's triple net, all the expenses. I would say most of the expenses are typically passed through to the tenant.
Yeah.
Um, so that property manager will oversee that. As an asset manager, your primary goals is to oversee the financials of the property. So you're seeing what the property manager is doing from an expense side. You're seeing how the tenants are doing. Your main goal is to keep the building leased up, and make a plan for that asset. So it's not like an asset management role of multifamily. So it's not as intensive as that. In our examples, you're talking 4 tenants. You might have one roll in 3 years, right? And
Okay.
then another one in year 4. So um, if you're not doing a development's a whole different beast. You're not really asset managing until you're stabilized, anyways. Um, so you're really focused on honestly keeping the building leased up and understanding your roll schedule and then maximizing your exit value. So trying to figure out when the best time to exit based on leasing is and um, you know, always understanding and analyzing the market. So as you gain a portfolio, that's more important. Where we're standing today, day one, we're looking at assets where we have plans in place to do development. So we're more focused on the development side than asset management today. But asset management generally, you focus on leasing and the financial aspect of the building, as opposed to understanding like heavily in occupancy on multifamily and really trying to
Hmm.
drive leasing and how we spend on marketing to gain more leases and that kind of stuff. You kind of on leasing side, asset management, you can in-house leasing and go direct with tenants in the market. My opinion on that is to hire brokers in the local market. Um, just
Hmm.
because you are going to get the highest rents, you're going to get more market knowledge, you're going to have access to more comps, especially if you're buying more properties in the market. You're going to feed the brokers, so they want to feed you more deals. So you'll find more off-market deals. The leasing brokers are the ones who bring you off-market deals.
Yeah.
A lot of these deals are brought through capital markets guys who are not, they're marketing the deals. So if you have good relationships with leasing brokers in the markets that you're trying to acquire in, you'll typically see some deal flow that they want to make that commission on versus pushing it over to their capital markets team. So there's definitely benefits to paying your local brokers.
That's very true, right? Hmm. That's a good idea, like a good strategy, paying the local brokers to, oversee the property as well as,
Yeah,
they,
especially if you're not there, right? So
yeah.
they'll take the tenant and tour them through. Let's say it's in Virginia, I'm sitting in Columbus. Well, and one of the spaces goes vacant. Uh, I can't fly down there every day. That needs to be a tour.
Yeah.
Sure, the property manager could take them through, but because it's business to business, you don't typically do that kind of leasing like you would at a property man or at a
Right.
multifamily where you have the property management also run leasing. So you
Yeah.
have the brokers run leasing, and honestly, it costs you the same in commissions and expenses, anyways. So you include those in your underwriting. You just got to understand what the market dictates the commission rates are because they fluctuate per market.
Hmm. Okay. So, uh, you have a vast experience in industrial space, right? You have been through many firms of REITs as well as different private equity firms. So, if you can give our listeners a taste of any tough or a challenging situation that you had faced within this industry, and how did you come over it?
Yeah, so I would say the biggest one honestly was during COVID, the beginning part of COVID,
Okay.
because and I was in California at the time. They had a lot of restrictions on evictions and restrictions
Mm.
on people going to the properties and actually working. So it was shutting down businesses. Um, and so part of the issue with that is people stopped paying rent. Um, and so that was the hardest part was tracking who wasn't paying rent and calling those tenants and kind of either pushing them to rent or trying to get them out of the space. That was when I was at Link. And so
Mhm.
honestly, that was, dealing with thousands of tenants in the smaller spaces. Some of those assets are I mean, you even see gym operators like your CrossFit gyms in there, and they couldn't operate for months and months. And some of these people, this was their only livelihood. So you had to give tenant. There was all kinds of different situations. You either bought them out to get a new tenant in there, you gave them concessions on their rent, or some of them because they were getting PPP loans from the government were able to eventually pay back the rent that
Mhm.
needed were required per the lease. So all kinds of different circumstances. I would say that was the toughest challenge. But the interesting part of COVID was after the initial like 3 or 4 months, it was the hottest leasing market in industrial because everybody and the biggest boom in development because Amazon was taking gobbling up space because effectively e-commerce sales moved forward 10 years based on the
Yeah.
projections of sales growth. So that really led to a boom in every sector of industrial, and vacancy rates went from 6-7% to across the country down to like 2-3%, in some markets less than 1% vacant, even including the big bulk spaces. Now you're seeing because the bulk development has went gangbusters, for lack of a better term, during that time. Now you're seeing some vacancy rates be above 5%, 6% in certain markets. And that's almost all primarily done by or in the bulk side. So that's why we're targeting the shallow bay. So it was interesting that the toughest challenge came during COVID and not knowing what was going on for 3 or 4 months, but then it ended up being the best time all as well for leasing. I would say by a year later, we were leasing assets. I did I did almost a deal a day during that time on the leasing
Well,
front. Yeah.
and
So
at the higher rent, right?
yeah, rents
Of
were
course, yeah.
driving. One of the biggest changes in the industrial space at the time in the markets I was covering in California was, and one of the things we were pushing was the market was always, or for a while, had moved to 3% rent escalations. And this is the
Hmm.
beauty of industrial, is that you have in place rent escalations where it's not, you don't have to, you know, just up the tenant's rent and hope they renew. It's already contractually in place because the leases are 3 to 5 years, somewhere in there, maybe even
Yeah.
10. But usually any 10s had like 2% bumps at this time pre-COVID. But you had 3% bumps. Well, in the markets I covered, we started pushing out 4% rental escalations. Some markets out west even got to 5%. So you're still
Wow.
seeing, and you're still seeing that today in the smaller stuff. Um,
Mm.
the shallow bay flex, you're still seeing, like, I'm underwriting 3.5, but the comps say 4. So that way we can, if we're outperforming our underwriting. So um, it's one of those things that was a shift. Not only did market rents go up, but so did escalations. TIs went down and free rent virtually went away.
Hmm.
Now I would say some of those things have come back. TIs are, more normal. Free rent is low, but there's still now some free rent being given. In the bulk space, substantially more free rent, but the flex space, almost no free rent still.
Okay.
And rent is still growing in the flex and shallow bay space. People are keeping the bulk space artificially high because they're not signing leases, or they're giving more free rent or TIs to keep those rents high, which ultimately drives your exit value, and that's the goal.
Yeah.
So keep the rents high, even if you have to give concessions on the front end
Yeah.
to get that higher rent based on your cap, or higher per square foot for cap rate because your rent's higher.
Mhm. All right. And how do you see this industrial landscape in the near future, like evolving over the next 5 to 6 years? How do you see that?
Yeah, so I would say, like, there was a pause in development on the bulk side recently.
Hmm.
And so over the next few years, you'll actually start to see people developing again, as a lot of this space is starting to get leased up on the bulk side. So vacancy rates are coming down. My personal thesis on the shallow bay and flex is there will be builders now building it. So there is competition and there will be competition, but a lot of these markets can handle a couple more, call it 5 to 10 more years of worth of development of supply before I would say that you might have an overbuilt situation. But that's today's view, and that may change 2 to 3 years down the road. We shall see how many people. But what is hard is land sites. Finding 5 to 10 acre land sites to build shallow bay or flex in key locations. It is tough to find and source. So I think there's always kind of a cap on that kind of development, that where because you don't want to build these things too far out of town like you do with bulk. You can, in Columbus, there's a lot of flat land around Columbus, so you can continue building bulk product. But if shallow bay is too far away from rooftops, you won't have employees, kind of like bulk, but people will travel to work for Amazon versus the mom and pop shop. So you don't find shallow bay too far away from rooftops.
Hmm. That's really true. Right now, hey Greg, loving this conversation, but want to be mindful of your time also. So we'd like
Perfect.
to move to the final round of questions. Are you ready?
Sounds great, Ted.
All right. So what is the one book that you'll recommend to our listeners which had the most impact on your life or on your business?
So I would say there's two, but I had already mentioned Rich Dad Poor Dad. I don't necessarily follow all the philosophies in that book because a lot of it teaches about it tells you to be a real estate investor, but then it's not and gain passive income, but doesn't really tell you that if you buy houses, it's anything but passive. So
Hmm.
it's really a job. So what we're trying to provide for people is to make it passive income for people. So today, I would say in the last 5 or 6 years, the most influential book for me would be "Can't Hurt Me" by David Goggins. I know that's probably not a common one said on
Yeah.
podcasts, but of real estate nature. But honestly, that book helps me with discipline and motivation. One of the things that's key to what I'm doing is being disciplined and focused, and then as well as being motivated to work hard, even though in the face of no revenue yet as a company and spending lots of money as well, and then taking some risks once we do sign
Hmm.
contracts. So, getting after it is really an important thing, and keep going, and eventually you'll break through.
Absolutely. Yeah, hard work will always pay off at the end, It's just you got to grind for a while and.
And you don't necessarily
Yeah,
know the results, right? Like if
yeah.
you start a workout program, if you look at the results after day 1 or 2, you might not notice anything, right? But if you have a picture from day 1 and a picture at day 90 or 120, you'll notice the
You'll see a
differences. And
difference. Yeah.
yeah, so
Yeah.
we're keeping on chugging along. Those first deals we underwrote 3 4 months ago, they all felt like losses when they didn't go across the finish line for whatever reasons, but we kept going, and we're continuing to see more opportunities and
Hmm.
better opportunities, and we've kind of refined and iterated our approach. But that can only happen by not giving up, and staying focused, and not letting the negative thoughts kind of creep in, and cause us to stop.
Yep, that's true. All right. What are your main source of information to learn and grow?
Oh man, that's a vast. But I would say right now I'm really enjoying my focus and growing in an area that I never have been focused, which is LinkedIn and social media. I was never a big poster. Now I'm posting 5 days a week. So
Hmm.
learning through that way, and learning through other people's posts, right? And who operate in our space, and understand what they're doing, and not necessarily industrial, because there's not too many people posting about industrial on a day to day, but more so learning from other private equity operators who are raising capital, who are doing multifamily deals, self storage,
Hmm.
any of the likes, and just kind of understanding what they're doing, and kind of trying to model myself after that with the deal flow that we have access to.
Okay. What is the best business or investment advice you like to give to our listeners?
Business advice, we've kind of already touched on, honestly. Stay disciplined and stay focused.
Yeah.
That's it's hard, it's easier said than done because you can get distracted on your day to
Mm.
day. But really, if you come up with a thesis, go after it, and then iterate towards what works. And then once you find that, just really drive that home.
All right. And which is the one habit or routine that's been crucial to your success?
I would say exercise, and
Okay.
healthy diet. So I am a avid work. I work out every morning between 4 and 4:30. I start my workouts. And eating healthy is key there. So is sleeping. So all those things kind of tie together. Just basically
Yeah.
generically, I would say the number one thing that makes this all work is taking care of my body. Right. And it's the one body, and it feeds the soul, it feeds the mind.
Yeah.
Um, and gives me the energy to for the long days.
Mhm. Now, so same for me also. Every morning, wake up, do some exercise, do some meditation, body, mind, and that's how the day goes.
Absolutely, it's the best when you get those in. And I very rarely skip a day. I mean, there is sometimes I have two young kids where you can't fit it in. But I would say if you took a calendar at a year, I would say I'm probably working out 97% of days, right? So that, and those days are my days I feel best. Sometimes it feels good to relax and take the foot off the pedal to recover more
Mhm.
so than anything. So you do need to mix in some recovery, but I like to keep it active on that too.
All right. Okay, Greg, last question. How can Decoding Cashflow listeners get in touch with you?
So I would say the best way to reach out to me right now would be LinkedIn. There's email links, there's phone numbers all throughout my website as well, greelcmp.com. I'm highly reachable. I'll be happy to take a call from any listener. and to discuss industrial further.
All right, Greg, that sounds great. And it was a pleasure having you in the show. And we'll surely stay in touch.
Thank you, Ted. Appreciate it.
All right. Thanks. Bye.
Thanks. Bye.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.